Good afternoon, everyone. Welcome to today's Wednesday market review. My name is Stock Darts, and we're going to do what we always do on Wednesdays. We're going to go ahead and take a look at the four major market uh, indices. We're going to look at the S&P 500, the Nasdaq Composite, the Dow Jones, and the Russell 2000. Once we finish looking at those four, we will then take a quick look at the U.S. dollar. We'll look at gold, oil, silver, see how they're behaving, and then we'll move on to chart requests. If anyone in here has a chart request, feel free to add it into the chat, and we'll get a chance to take a look at it once we cover the markets. If you like what you see here, you can always follow me at Twitter on Stock Darts, YouTube Stock Darts, or you can visit me at patreon.com/StockDarts, where I post weekly blog content including trade ideas, as well as just expanding on some of the thoughts and ideas that we come across during these Wednesday market reviews. Other than that, let's go ahead and get started. First thing we're going to do is take a look at the S&P 500 through the ETF SPY. Now, we've had a big week. We've had a big last week. We had a big week before that, and the market just keeps going up and up and up and up. Now, the problem with this, of course, is that the market keeps getting more and more stretched out, more overbought, and it becomes difficult to actually find good trading opportunities when a market is at this sort of point, because the risk reward's just not there. What happens now at this point is all the good names or all the strongest stocks have moved up, and we're caught in this loop of trying to search for names that still haven't really broken out, which of course are the laggards that maybe don't have the same strength. Now, the other side of that coin is that you can find some nice gems that are maybe ahead of the market and had already broken out and are just consolidating after moving upwards, and that's kind of what we've been trying to do. Along the lines of trying to figure out where money's rotating. What happens during a market like this is, while the market itself is moving up, there are a lot of stocks underneath the surface that maybe aren't quite in the same place, and so you have to try to play this game of trying to predict where the money's going to rotate to as people take profits in some of the more overextended names. Overall, if you just look at it, it looks like a pretty easy market to trade, and truthfully, most of this year, since about April to May, has actually been a pretty easy market to trade. Matter of fact, even the first couple of months were really easy to trade. Of course, it was very difficult to trade once we had the crash that came in with the coronavirus. But since then, with all the liquidity that's being pumped into the system, this market actually has been a fairly easy market to trade with only a couple of speed bumps along the way. If you look back and you just take a look at where we've been, there have been very few corrections with any kind of real impact in the market, right? We had a point here where we kind of traded sideways, and we had a couple of shakeouts, and maybe over here back in May there was a point where we started trading sideways, but for the most part, the market's just gone up, and a lot of strong names have gone up with it, and overall it has not been a difficult market to trade, other than the fact that sometimes you get these points where the market starts to get stretched out and it becomes a little bit more difficult to actually find names to go ahead and trade. And then the other thing is, without any substantial pullbacks, it's a lot harder for value traders to try to get involved. These kind of markets have worked well for short-term swing traders. However, for longer-term traders, if you kind of missed the entry here in late March and early April, you haven't had that many opportunities. Now, you have had opportunities. Even long-term traders that like to enter when the stock market corrects, or when you have broader periods of consolidation, they have still had opportunities. We still had a nice base that formed in May, and we still had this nice, again, base triangle that formed in June and July that gave good opportunities for those that were waiting for the market to correct a bit and were scared to kind of chase the price action upwards. But generally speaking, this market has been one, for the most part of this year, that's been rewarding the shorter term swing traders that like to kind of just take quick shots at the market as it climbs upward and try to figure out where money's rotating to. And that's really been what's been kind of producing well, particularly over the last 3 or 4 months. Now, again, not to say long term hasn't worked. Obviously, anyone that bought in March or added in March has had a fantastic time. My long term accounts have actually been have done incredibly well, almost embarrassing my returns on my short-term accounts, which is interesting since my short-term trading has actually been very rewarding this year. But when you go ahead and add stuff like Tesla or Amazon or Zoom around these levels, they just, it dwarfs anything that you could really produce with normal swing trading. But overall, the market has done well, and it's been very strong. And the issue, again, like I said, is just that we are not getting enough pullbacks for traders to want to get in at value. And so they have to be careful about what they pick and have to really dig around looking for good risk reward. And I think that's been one of the trouble spots these last couple of weeks, in particular, has been that if you weren't really invested in some of these high flying tech names, it's been a little bit more difficult to get return. Now returns have been there, but they haven't been quite as widespread as maybe what you would have seen in July and August. So right now, if you take a look, obviously the SPY is a new all-time highs. We printed new all-time highs the day before, the day before, the day before. Matter of fact, we've printed new all-time highs now. What is it? 1, 2, 3, 4, 5, 6, 7, 8, 9 days in a row. So pretty nice bump up. Now, one thing I'd like to point out, especially if you take a look at the broader picture, since about June, since we had this triangle that formed, the last time we had any kind of real substantial correction, we've gone pretty much straight up. But you'll notice volume continues to dry up, right? So momentum is slowly dying as we continue to climb upwards higher and higher and higher. Now, what happens in these scenarios is you have the psychology of the rising wedge, right? And you can see we had a rising wedge that formed here. We had a little bit of a shakeout, then another rising wedge, and at this point we're rising so steadily that it's not even a wedge, it's just a tight little channel. But generally speaking, the psychology of this price pattern is one where you have nobody willing to sell, right? And everybody wants to buy. And so what ends up happening is you build this imbalance. And this imbalance has been building up for a while. Now, you do have times where you can kind of alleviate that imbalance, and that's why we've continued to climb upwards, is because we did have a couple of these moments where that condition was alleviated shortly, right? So we had a nice sideways week and a half to 2 weeks of price action here. And that did a good job of alleviating some of the overbought conditions and some of the imbalances that were starting to really accumulate as we climbed upwards. And the same thing happened even prior to that. Over here, you can see we had a nice week, maybe 7 days of trading sideways, and that did a good job again of kind of relieving some of the pressure that was building up as more and more longs piled up and shorts just couldn't really affect the market. And what happens in that scenario again is you have no one is willing to sell, and then traders that want to get long have to chase the price action upwards, and so it builds up. It's basically the same psychology as a short squeeze, but it's not necessarily because there are shorts that are being burnt and have to buy to cover. Sometimes it's because there's just too many longs and there's just not enough shorts to take the other side of the trade. And what ends up happening is market makers have to take the other side of that trade, and they want to be neutral, which means that a lot of times they have to go ahead and when if they're selling you shares but they want to be neutral, they have to buy their own shares of their own options, and that kind of fuels this squeeze that keeps going up and up and up until eventually it kind of breaks down, and then that imbalance is finally shifted to the other side. And typically it doesn't happen like what we've seen over the last month and a half, which is these little sideways moves. Typically you get these pretty sharp moves to the downside, where all of a sudden everyone has to unload their longs, and the market makers in particular have to go ahead and rebalance with shorts to cover and then back to long side. So what happens in those scenarios is you get these quick drops, but they're not necessarily market tops or the beginning of a market crash. They're just these quick moves where you have to alleviate the conditions that are preceding that, which again is this overbought kind of stretched out market. And so we're reaching a point now where we are probably close to getting another one of those quick drops, even if it's just 1 or 2 days. And when that happens, typically you have a quick move back down. It's not necessarily the end of the world. I've pointed this out repeatedly, but if we even go back and take a look at what happened late last year and early this year, you'll notice we had a string of rising wedges. And often these rising wedges culminate into 1 or 2 3-day drop, and then it just resumes its normal regular climb. And again, you can see we had a drop, and then maybe it kind of took a week to stabilize, and then we had another one. And then eventually we had the coronavirus drop, which of course was the one that really kind of ended here. But this is not normally the case. This is kind of like a black swan event that happens every now and then when the market has these exterior forces that come in and really impact it. But if you're just trading off of market dynamics and you don't have crazy news to come in and affect the market, a lot of times these rising wedges don't necessarily end in market tops. What they end up as is just these quick drops as you have that imbalance that needs to be readjusted, and then the market kind of resumes what it was doing before. So I think we've reached a point where we need to see another one of those drops. But again, I'm not saying that it's a market top in any way, shape, or form. It's one of these things that needs to happen in order to kind of correct some of these imbalances that are occurring where there's just too many buyers right now and there's not enough sellers. Um, and if we see that, we should see a quick move back to the 20-pair moving average, and probably down here to about 340, which would be the previous all-time highs from earlier in the year. And I think that's a good place to look at buying the dip and looking for buyers to step right back in, because again, there's still strong demand in this market. Now, if you're looking at this and you're telling yourself, well, this market has gone up too much and it needs to go down, it's fine to have that idea. You don't want it to go ahead and overly affect the way you're trading. So what you want to do in that scenario is if you really think that we're close to a market top, then you want to wait for that drop, of course. But what you want to do is you want to see what happens as we come into support, as we hit the 20-pair moving average, as we hit this 339, 340 level, as we hit the 50. And if you start to see selling start to overcome the buying, and you see these support levels fail, then that's when you start to get the go ahead to start looking at short trades. But I think at the moment, despite the fact that the market is probably should pull back in the next few days, it's not a good idea to short it, because it could be similar to what happened these last couple of times where we don't even really sell off. We get one red candle and then we just drift sideways and then continue to squeeze upwards. So with as much demand as there is in the market right now, shorting is not a good idea unless it's a very weak name that in particular has very little correlation with the market. But if you're looking at just trading stocks that are highly correlated with the market or behaving very similar to the market, I think at the moment it's kind of a fool's game where you're thinking that gravity affects stocks, and it doesn't. Gravity doesn't actually move these things. They're not really based on physical reality. So they can continue to squeeze upwards. They can continue to climb upwards as long as there's demand and as long as this imbalance is in place where there's just no one willing to sell, because there's nowhere for money to go other than the stock market if it wants a healthy return. So you have this scenario again where the market just kind of keeps squeezing upwards, despite it being far above what many people would consider to be appropriate, considering where our economy is right now. When you consider how many people still don't have a job, how many businesses still remain half closed, if not fully closed. But the market isn't always necessarily equated directly to what our economy is. It's forward thinking and has an expectation of where it expects us to go. And again, there's always stuff underneath the surface like stimulus that can affect it, or a weak dollar that can affect it as well. And so it's not always a direct equivalent to what our economy is, despite the way we would necessarily visualize it as that. All right, so as far as the S&P 500 is concerned, looking at levels, like I said, 340 is a really important level. And if we do pull back, even if it's pretty sharply, and get there in a day or two, I still expect that to be a level that's going to hold the support. You can see again, we're in a very strong trend. The moving averages, the 20 and the 50, are moving upwards like train tracks, and it's going to be hard to get that train to stop. Usually a train takes a little while to slow down in momentum before it can turn around and go in a different direction. So we're going to have to see the price action erode, where we start losing the 20, test the 50, and eventually lose the 50, and these moving averages flatten out before we can consider a change in the character of the market. So for now, consider the trend up. I don't expect 340 to be breached between here next Wednesday. If it is, I expect the 50 to hold the price action pretty well. If we fall below that, 320 is a very critical level, and this would be a very important level that if we ended up losing would be a very big change as far as I'm concerned with the market, because that would mean that it definitely couldn't hold at new highs. Not only did it not hold at new highs at 340, but it came all the way back down and started to have trouble with the support levels that should be holding it. So that's a key warning area. Now, of course, if we move in 1 week from here to there, at that point it might be too late as far as the warning system is concerned. But I don't expect that to happen. I expect us to come down, find buyers at 340, If the buyers can't sustain the price action enough to push it back to new highs, and we lose that, that's when we have to start worrying about 320. But as long as there isn't news that comes out of left field, I don't expect us to really breach this area between about 340 and 330, which again is this level that was the previous highs from earlier in the year, as well as the 50-pair moving average. So those are the two support areas that I think are going to be relevant in the next couple of weeks. As far as to the upside, there's no upside, or at least no upside targets. I mean, we're at all-time highs. There's no, the only resistance up here is theoretical. So there's not. I'm not going to really point out anything other than maybe take a look at this channel that keeps building, and if we break to the upside of it, that's not necessarily a good sign either, because that's usually kind of a blow off top, and then it kind of comes back down. So in either direction, really. There's really no signal here that I would consider to be too bullish. If it continues to kind of come up in that level, it just means that we're getting closer and closer to the point where it needs to pull back. So if you're excited about trying to get long here, just be careful. The market, like I said, has printed new all-time highs like 9 days in a row. So just the normal ebb and flow of the market dictates that we should be getting a pullback soon. And if you try to get long now, it could be a stock that is going to end up being higher in a month, but if you bought it when it was up 9 days in a row, it might need to come back down and trade sideways or down for 5 or 6 days, and you end up stopping out and then missing it when it turns around and comes right back up. So I don't think the timing is really that great right now to go long too well or too strongly, but I think that overall, with the health of this market, that's still really the direction we want to be focused on. Now, similar to the S&P 500, we have the NASDAQ, and if anything, it's even more exaggerated. You can see we've basically gone up for about a month now. And if you look, we've printed new all-time highs 1, 2, 3, 4, 5, 6. I don't think we did it that day. 7, 8, 9, 10, 11 out of like the last 13 days, we've printed new all-time highs. And even more if you count somewhere in here. So, again, just the market ripping upwards. We're going to get into the FANG stocks a little bit later. You'll see just how strong all of them have been. And I think, again, showing the disparity between where tech has been this year and where some of the other more industrial or retail-based names have been this year. Because, again, with us being forced to work from home, shop from home, find entertainment at home, a lot of these tech names that provide those services have been pretty well insulated from the impact from coronavirus, and if anything, have actually benefited from it. And that has caused the NASDAQ to really swell in value and to continue to climb upwards. And if there's one place where we're really getting that imbalance, where there's nothing but buyers and the only sellers are market makers that are basically have to give us the other side of that trade, you have this squeeze upwards where the market just keeps going up because there's no one that wants to sell any of this. And like I said, sooner or later there's going to be an imbalance. There will be the weaker hands that need to get out of it, or there's going to be just an overabundance of longs that need to close it out. And once that happens, you get this turnaround effect where it escalates in the other side and it kind of snowballs down, because then you have the market makers that have to start rebalancing their positions, and then you have the weaker hands that start to panic and get out of their positions, and that's why you get those quicker moves to the downside. And that's kind of what I'm waiting for again on the Qs as well. Now, as you can see, we're so far extended above the 20 and the 50 that if we do have that quick move down, it might just be moved back down to the 20-pair moving average. And again, you can see the trend, how strongly it's in place. The 20 has held and supported price action since way back here in April, and we haven't even tested the 50 once. We had a couple of times where we actually breached the 20 for a few days, but then we just kept climbing upwards. And so it's the same story that we've been harping on since March, which is if you want to be long this market and you don't really want to get involved with individual names, then you should just be long the Qs. And again, this is something that we've been saying since all the way back in March. It was pretty clear that tech names are going to be the ones that were going to survive this and we're going to be able to kind of benefit. And the Qs, as you can see, has performed exceedingly well throughout the year and continues to really continue to push the envelope a bit. And we've reached the point now where we would have to have a substantial correction, almost like a crash, just to get back to the highs that we printed at the beginning of the year. Previous highs that we printed back in February is 237, and we are all the way up at 300. So we'd have to lose, what is that, 60 points just to get back to the highs from earlier in the year. Um, so it's pretty clear that we've left behind uh, where we were to start the year and where we were when the coronavirus hit, at least as far as tech names are concerned. And again, this shows that the market is still very strong, and it just continues to ride upwards. Now, a lot of people are saying that this is a lot like 1999, where everything went up, and I don't necessarily want to belittle that opinion, because there is a certain element to this where stocks just keep going up, but it's not the entire market, and it's not quite the same sort of enthusiasm that you had at that point. But it is starting to reach a point where there are certain names that just go up, but they have been kind of trading back down. And I don't think we're at a point right now where we could call this. I know some people say this is a bubble. I don't think this is really at a point where I would call it a bubble yet, because again, we're not seeing that across the board. We're only seeing it in certain areas of the market, um, and generally speaking, we're still seeing levels of consolidation. We're seeing rotation out of these names as they pause for a breather, even if it doesn't look like it, right? So, yes, we've gone up quite a few days in a row, but if you look at it, the Nasdaq traded sideways from July to August, right? And it basically was alleviating a lot of the overbought elements that were kind of leading up into it. Again, traded sideways for a bit back in June and July, and of course even back here in April it traded sideways for a while before it really started to break out. So it might be in the middle of an overbought state, but to call it a bubble right now I think is a little inaccurate, because we're not really at a state of that kind of price action yet. Now that being said, it is overbought, and like I said, it should come back and shake out some hands, because at the moment there's just too much of an imbalance here. There's just too many buyers and not enough sellers, and typically the longer this persists, the more violent it is once it finally shakes out. Now again, that violent move might only be a day or two, but it should be something that moves down. And as you can see, even a move back to the 20-pair moving average would be about 20 points on the Qs. And that's probably what I would expect to happen. And I think that's probably going to happen anytime in the next week or so. So at this point, we're at a spot where I think it's prudent to start looking at protecting yourself by making sure that you're not overly exposed if we do have a drop, and making sure more than anything that you're not chasing the price action upwards. If you see a chart that has this pattern, you don't want to go long. You want to make sure that you are either taking some profits or protecting your profits with either puts or something of that nature, in order to reduce your exposure if we do end up dropping. And of course, that's for swing traders. Long-term traders really just have to kind of go with the flow and let this do what it's supposed to do. I don't know that there's enough signs here yet for me to want to raise cash. The market is just so strong that I'm just happy taking what I get from it. And when it eventually corrects, it will. But it will have gone up so much from where I had entered that I don't care that it does correct. At this point, this thing could correct 50%, and I'd still be fine with where my long-term holdings are compared to where they were earlier in the year. Now, we look at the Dow Jones, and you see a bit of a different picture, of course. We haven't printed all-time highs, and we're not quite as stretched out as before, but even in the picture in this case, we have breached a pretty important price point, which we discussed last week, which is this 283 level, which again was a critical support zone earlier in the year. You can see, again, we had the rising wedges even on the Dow Jones. And then that was a key support area that supported price from December all the way to February. And then we lost that, of course, once we entered this coronavirus phase of our year. And we finally made it back through there. And matter of fact, we actually filled that gap today. So positive price action. So the Dow Jones is following the other two, the SPY and the Qs upwards, and trying to play catch up. It still has a lot of work to do to get through all-time highs. If it does so again, I think it's at this point we have to assume that it will at some point push to new all-time highs because of the strength we're seeing on the S&P 500 and the Nasdaq. It only makes sense that eventually the Dow and IWM will follow suit. But for now, I consider that to be very strong resistance. and I would not expect the Dow to push through that without another correction on the S&P 500 or the Nasdaq in order to build up more momentum for that. I don't think that the Dow or IWM having a momentum to really push through all-time highs until we see a broader correction and a more substantial base being formed in the price action. So that would be a short-term ceiling that I don't expect us to push through right away. Is when the Dow eventually comes up into the 295, 296 area. Now, at the moment, it's still fairly bullish. It's doing everything the right way. You've got the 20 and the 50 period moving average starting to mimic what we're seeing on the S&P 500 and the Nasdaq. We had this nice consolidation that I was able to break out from. Then I had a nice 3 or 4 day trade sideways, and then it finally broke out from that. And I think at this point, what you would expect is whenever we do see some selling pressure come in, ideally the Dow Jones will come back and retest this 284, 285 level, and it's 20, and it'll have those serve as support, and it'll bounce off of that, and then make its way back up towards all-time highs and see what it does at that point. So, generally speaking, everything here is bullish, even if it is lagging what we're seeing on the S&P 500 and the Qs. And we're seeing today, by the way, a little bit of early signs of rotation out of the tech names and into the Dow Jones. Not really exaggerated, and we're seeing some of that strength in the SPY as well. But we're seeing a little bit of rotation into the Dow, and some of these Nasdaq names are pulling back a bit after the explosive moves they've had over the last couple of days. And so we'll see whether that's something that persists into next week. And if that's the case, then the Dow will continue to kind of make its way upwards, rather than come back and fall back below these levels. Now, what we don't really want to see is the Dow fall back below 283 and fall below its 20-period moving average. And that could occur if we see the sharp correction, even if it's only a 1 or 2 day correction. But if we do see a big red candle on the SPY and the Qs, then there's a decent chance that the Dow might end up falling back below 284 and below its 20-period. And I think for something that's lagging like the Dow is, the 50 is the more critical moving average to really worry about. You can see that's what supported price action in July, and even back here in June, and even back here in May. So the Dow Jones, because it's more of a laggard, has had to come back to its longer period moving average. But that would be the level that I would get worried about, is if we came back and the 50 didn't hold. But ideally, if this bull market is to continue as strong as it has been, then we don't really want the Dow to lose the 20 or to lose this 284 level. So if we see a big red candle on the SPY and the Qs, maybe that means there's more rotation coming into these, the Dow and IWM, and maybe they don't necessarily mimic the downward action quite as strongly as those, and they hold up. And if that's the case, then maybe we'll see it hold up at this level. But that's kind of a critical area we want to watch, is how it performs as it hits this 283 level, and the 20 period just below that. And again, like I said, if it falls below that, I think the 50 period, which is also going to coincide right around this area, around 274, 273, that's going to be a critical support zone that, again, is right around what its previous highs from earlier in June. And that would be the level of support that we would hope would hold, even if it lost this longer-term support from back in February and January. But overall, also bullish. Maybe not as strong as the S&P 500 and the Nasdaq, but doing nice things as it continues to climb upwards and make its way back towards the highs from earlier in the year. So again, showing recovery as far as the stock market is concerned compared to where we were back in March. Now, the last one, of course, is IWM, and as you can see, the small caps have struggled, even over the last couple of days, really not printing new highs. We had a nice little bull flag, but the price action kind of degenerated downwards off of that. And what we have here is we have this level. Now, on the bright side, this 155.60 or so, which was the bottom of this little bull flag, we fell below that, and then we were able to kind of make our way back above it. And at this point, I think we could say that it's starting to break this bearish momentum or this bearish sentiment that was starting to really come in around the 159 level. So IWM is slowly trying to climb and slowly trying to follow its stronger peers, but it's not really doing a good job of it. And again, if we extend this red line, which again is pretty important level from earlier in the year, you can see we're really struggling with that price point, and it's a level that's holding us back on IWM. And if we can break through it, there's still significant overhead resistance that I don't expect to be breached unless we have a more substantial market range develop where we can base out for a bit and let more buyers and sellers kind of figure out where they want to go next. I think at the moment the S&P 500 and Nasdaq have been so strong that buyers haven't really been able to do much other than chase the price action. I think in order for IWM and the Dow to be able to break to new all-time highs, we're going to need a little bit more of a stable market where there's a more ebb and flow to it, so that buyers and sellers don't feel forced into trying to get into the into new highs. And so I think that's the psychology behind where we need to be in order for these two to participate as strongly as the other have. But overall, it's still bullish. It's still everything it's done is still constructive. We've still been able to kind of make our way upwards throughout the year. We had this sideways price action that we were able to move past. We have the 20 and the 50 pair moving average climbing upwards, forming those train tracks as we get through the 200. So, overall, it's still indicative of a nice, healthy trend, and overall is still doing good things here on IWM. So, generally speaking, I think it's still pretty bullish. And things are still doing well here. I think my chart got stuck again. Are you guys seeing the IWM chart, or